So is it time to buy the EM dip? Joining us for an exclusive interview, Mark Mobius, founder of Mobius Capital Partners. Good morning to you, Mark, and who better to speak to on this very subject? So we've seen a sort of levelling off of emerging market assets, it seems, in the last few sessions or so, Mark. So is now time to get involved? Do you dip in with one toe or two?
Well, I'm kind of unhappy to hear there's a recovery because, as you know, we're launching our new investment trust. And I want to be able to buy cheap stocks. So please don't push the prices up too much. But I think we've been saying for a few months now that, you know, we're nearing the bottom. It seems like things are very cheap. And even if we're not at the absolute bottom, it's a great time to be buying because there's so many bargains out there.
OK, Matt.
What would make you more sure that we were at the absolute bottom? We've seen, Mark, these stocks, this is the MSCI Emerging Markets Index, come down 20% from their highs. Is that enough, just being in a bear market, or are there signs like consumer spending or a turnaround in the trade war that make you think we could turn around and go back up?
I don't think there's going to be a turnaround in the trade war with China and the U.S. yet. There's going to be more pain. But you must remember, there are winners and losers. So if you want to look for signs, you probably want to look at Turkey, Argentina, these countries that are really bombed out. And if there's a recovery in those countries, then it would be a sign that we're nearing the end of this big bear market.
And what about things that are outside the control, Mark, of emerging markets themselves? The dollar, the path of the Fed, for example. To say it's time to buy emerging markets, do you have to say the dollar's, you know, nearly there, the Fed is nearly there, the Fed is nearly done with tightening, or can you buy emerging markets even if you expect a lot more Fed tightening to come?
Well, with more Fed tightening, of course, the dollar can get stronger, which is good for exporters in emerging markets. So what we see, a lot of the exports from China with this trade war will be going from other countries, other emerging market countries, Vietnam, Bangladesh, Turkey, all these currencies that have gone down dramatically are going to be the winners in the sense that the countries with those currencies will be able to export more to the U.S.
Mark, we heard this morning that China is considering further measures to reduce tariffs on for a whole host of countries, it seems. So away from the trade tensions, there are other stories around the Chinese consumer. They're trying to boost demand from Chinese consumers, it seems. Where do you see opportunities to tap into that growing Chinese consumer, the growing Chinese middle class? Give us some good ideas.
Very, very good point about the consumers. Not only in China, but all over the world, in emerging markets of the world, because consumers in emerging markets are becoming richer, they have more money, and if you look at our model portfolio, the top sector is consumer discretionary. So we are definitely looking at the consumer in emerging markets.
So even though it's discretionary, there's something solid enough about these economies at the moment that you think this is a structurally growing story as well as a cyclically growing one.
Exactly, because in the discretionary area, a lot of low-cost consumer goods, soft drinks and all kinds of food items, snacks, that sort of thing, are growing very, very fast.
Where do you see the biggest risks then, Mark? I mean, is the dollar the biggest risk? Are you worried about the Fed continuing to raise rates? Are there structural problems in some of these emerging markets that concern you? The trade war, what is it?
I think the biggest risk, short-term risk, would be a downturn in the U.S. equity market. I mean, that's quite possible. You can have some event, whatever it may be, causing a big fall in the U.S. market. That would frighten capital markets around the world, and you will see a correction not only in the European markets, not only in Japan, but in emerging markets as well. So I would say that's the biggest risk that we face.
And with that in mind, do you worry about yields in the US being above 3%? Is that a marker that matters for the emerging market story?
Definitely. I mean, as the yields go up, of course, people will be attracted to the dollar unless the Europeans raise their rates, unless other countries, of course, emerging markets have been forced to raise their rates up to now. But unless that happens, you're going to see a drive into the US dollar more and more.
You've seen emerging market crises for decades now, Mark, and a lot of people were comparing at one point the slump that we saw in EM over the last month to what we saw in 1997. The word contagion came up a lot. It doesn't look like it's gotten to that, but how would this compare among the crises that you've invested through?
Well, let's just take Argentina. We were investing in Argentina in the early 90s when the inflation was 2,000%. So you can imagine this is very mild when we look at the general history of what's happened in emerging markets.
The emerging market contagion story, we can talk about it whether one emerging market is contagious to another or whether the emerging market sell-off is contagious to developed markets. How does all of that fit, do you think, this time around? Because every sell-off in EM is different.
Well, you know, the contagion is a psychological concept because if you look at emerging markets around the world, they're so different. The variety is incredible. So you really can't rationalize the fact that Argentina is down and therefore Vietnam should go down. They're so different. So that's the beauty of the situation. Of course, if there's a belief that there's contagion and everybody sells, that's good for bargain hunters because you're going to find opportunities in those countries that shouldn't be contagion prone and are doing very well.
Are these developments in Europe, especially with sort of the populist right moving into the spotlight, and with Brexit looking, at least today, I mean, it looks different every day, but today more and more like no deal, does that affect your investment decisions at all in emerging markets?
It's an amazing situation that's happening. It's having with the Brexit and Europe. And investors are looking at that and saying, hey, wait a minute. We talk about political instability in emerging markets. How about Europe? How about the situation in Brexit? It looks very unstable. So in some ways, it enhances the appeal of emerging markets.
And I know that recently we were talking to you about where you see further downside in emerging markets, and maybe you can update us on that. And as we watch these pictures of a European heads of state gathering, are you concerned about certain Eastern European countries because some of them outside the euro seem to be trying to join forces to push a particular political agenda? How much is that on your radar as an emerging market story to watch?
Very, very definitely. It's an important development because with Brexit, you're having centrifugal forces taking place. Some of the old guard in the East European countries are saying, wait a minute, why should I comply with what Brussels says? And that's not a very good development because one of the wonderful things that's happened in these countries is that they've adhered to the EU rules and regulations.
Will that be bad or good, though, for the assets of those Eastern European countries with an emerging market sort of mindset?
The degree to which they disobey Brussels will be bad.
Okay.
Because it means that, you know, rule of law and the whole idea of fair treatment will go out the window.
All right, Mark, it's been a pleasure talking with you. As usual, wish we could have more time with you, but thank you so much for coming by our European headquarters there in London. Mark Mobius, founder of Mobius Capital Partners.